my pleasure to talk about my current research with my two collaborators at Indiana University and Yale University. Okay. So I'm going to talk about mortgage banks. So most of us probably think they're villains because they were the ones who manufactured these tons of low-quality mortgages that flood the market and eventually brought down the market. Okay. But whenever you try to blame them to be the predatory lenders, they came up with a defense. Say, look, okay, we were the ones that suffered the biggest losses, and we were the ones who fell the first. Okay? So what was the last time that you saw that some predators actually would fall first? Okay, so here's the dilemma that our research attempt to address. Okay. There are many layers in mortgage financing. I just want to outline three. Okay, so the first layer is that between the lending bank and the third party, usually we call them brokers. Okay, for certain mortgage banks, okay, actually more than half of the mortgages are not directly issued by the bank, but instead issued by those mortgage brokers. So who are those mortgage brokers? They could be the ex-pizza delivery man. Okay, so that happens. Okay. So the question would be, these brokers only care to earn some commission, and they really don't care whether these loans will go back in 5 years or 10 years. They already collect the commission. Okay. The second layer is that between the lender and the borrower. Okay. So in starting from 2003, 2004, one particular type of mortgage became very popular. Those are called low documentation loans. Okay? In the past, if you want to apply for a loan, you have to prove you have the qualification. Okay? Now, this is the beauty of the low documentation loan. So there are loans called NINA, meaning no income, no job, no asset. The NINJA's no income, no asset, no job. You don't need to have anything to qualify for a loan, okay? But someone's willing to lend to you. So when you don't have to provide proof of what you own or what you earn, you can falsify the information. You can claim that you earn $1 million a month. That's why you can get to live in that $10 million mansion. Okay? Then the third layer is between the originator, which is the bank, and investors in the secondary market, and that's through securitization. Okay? And for some of the major mortgage banks, actually close to 90% of the loans, they would sell almost immediately to the secondary market. So they really don't have 100% of their skin in the game. And 90% of loans, eventually, if they go bad, it's the problem with the secondary investors. So maybe they will loosen their screening effort in issuing the loans. Okay. So this is our sample. So we were lucky to get a proprietary data from a top national mortgage bank. So this is a density map. You will see that this particular bank has operations across all states, including Hawaii and Alaska. And moreover, the density is roughly proportional to the population density, although you know that there are particularly a lot of business in California, Florida, but we know precisely these were the places that didn't do particularly well. Okay. This is their per product mix. Okay. So these purple bars were the number of thousands of loans that initiated. So these were the bubble period, and suddenly the experience dropped by early 2008. Okay. And this is the category where I sorted by the 2x2 classification. So if you see bank, meaning these loans were initiated by the bank. If you see brokers, then it's a broker who initiated the loan. If you see the full doc, that means the loans require actual certification about what you state about your qualification. And if it's low doc, it has all a variety of the reduced requirement all the way to no documentation. Okay? Now, what was the most popular category? It is this. And this represents the low documentation loans initiated by the brokers. Okay? So if I tell you that this bank actually 28% of loans were delinquent by early 2009, you should not be too surprised, although a normal bank probably would stand a delinquency rate of 2 to 3%, you can still sustain. But if 28% of your loans go bad, that you would expect that this bank already ended in the hands of the FDIC. Okay. Now let's look at the first issue. What would be the consequence of letting brokers to initiate loans on your behalf? Okay? These are just simple statistics. This would be the delinquency rate, meaning if you're at least 2 months behind your payment. This would be the delinquency rate of loans in each category. And these are the loans that are still in good standing by the end of the 5 years. Okay? Now, we will see that overall bank loans are much higher quality than the broker loans by comparing these numbers. And full doc loans are better than low doc loans. There are two possibilities. Okay? So the brokers will say, well, don't blame me that I'm issuing low quality loans because my job is to penetrate the market that were traditionally underserved by the banks. Okay? So you ask me to penetrate those poor neighborhoods with people with lower than median income. What do you expect? Okay, so this is one explanation. Okay? You are lending to observably worse quality borrower pools. But another explanation is what we talk about in class about adverse selection, just to mention that topic both in my MBA and PhD classes. Okay? So this is that the low doc loans of brokers attract particularly worse types, like dishonest people. These are not the characteristics you can observe. Okay? Now, what we find is the following. Okay? If you compare the bank loans and the broker loans, okay, 3/4 of the differences in the delinquency rate could be explained by observables. Okay? So indeed, whom do brokers lend to? Okay, so they lend to less experienced borrowers belonging to groups that have lower credit quality on average. It's an average statement. So who are they? They are first-time borrowers, people with low credit score, low income, tend to have females as household heads. So these tend to be the single mother households who on average have lower income. Okay, they tend to be minority, tend to be young, and have short job tenure. Okay, so these, not surprisingly, these loans would have worse quality on average. Now, the interesting thing is the contrast between full doc and low doc. Okay, if you just compare what can be shown on paper, the low doc borrowers are actually better on paper, slightly better on paper. Okay? So they tend to borrow with lower loan-to-value ratio. They tend to have a higher credit score. They tend to have a high stated income. They're not first-time borrowers, and they're more likely to be self-employed. Okay? So here it's not like the low doc loan attracts people who are noticeably poor or noticeably younger. They actually attract people who are better on paper, but worse by inherent unobservable qualities. Okay? So our analysis find that 100% of the differences in loan performance can be attributed to adverse selection. That's due to reasons that you cannot observe. Okay? So for example, what are the people who would apply for a low doc loan? So the cynical example would be a divorced man who has to pay a high amount of alimony. So you go for the low doc loan, you don't have to disclose that potential liability. Okay? But that man could have high income or long job tenure, etc. Okay? So this is what we find as difference between full doc and low doc. Okay? Now the second issue is how much do people lie? Okay? So that question was really kind of triggered my curiosity. So I want to know, if you don't put any bounds on people's honesty, you allow them to lie, because when you apply for a low doc or no doc loan, you don't have to provide your W-2 form or tax return file, etc. So feel free. Okay? You can state whatever income you earn. Now, how much do you think that people will lie? What would be your guess? There's no bound on your honesty. You can lie about income whatever way you want. Would you exaggerate your income by 100%? 500% or 50%? Like, how much would you lie? Okay, so that would be the curiosity. And we actually estimated that. How do we estimate that? This is our, what we call academically called identifying assumption. Okay? So any estimation, you really have to make assumptions. Of course, the weaker the assumption, the better. But no assumption, you really cannot go anywhere, because so many of the information variables are not observable. Okay? So here's the assumption we made. Suppose you have two individuals, A and B. They are observationally identical. So you cannot tell A from B from any of the attributes, except that A has higher true income than B. But this true income is not observed because you state your income. Okay? But we just assume under this scenario, then A is no more likely to resort to a low doc loan than B. Because if you truly have high income that you don't mind showing your W-2 form or tax file form, okay? Then you can apply for full doc. So that is, we believe, a very weak assumption. Of course, this may not hold for self-employed because they might want to hide income because they don't want to pay tax. So we exclude that from the sample. Okay? So we use this information to estimate the lower bound of exaggeration. Okay? So the statistics will be relatively simple. We project the income on a full doc loan by using the attributes that the literature or people agree that will affect income. Okay? So for example, high quality, high credit score people tend to have high income, and overall female household heads tend to be in household that command lower income. Age is usually positive related income, etc. Okay? And we applying this prediction model on the low doc, and we find the following. So the average exaggeration is about $1,800 a month, or 29% of the average income of the mortgage applicant. Okay? The median exaggeration about $700 or 20%. So I was kind of impressed. So when people are allowed to lie without bonds, they lie quite modestly. Okay? So they lie up their income about 20% at the median, a typical person. Okay? Now what is cool about this result is that if you don't adjust for the lying, you will find people with high stated income have higher delinquency rates. So that's very counterintuitive. You will think the richer you are, the less likely you're going to be delinquent on your mortgage. But the trick is that stated income. So the high stated income, more likely, it shows your dishonesty, and that is correlated with delinquency propensity. Okay? So once we adjust for this, we recover what we believe to be true relationships. Okay? So estimated true income and exaggeration negatively correlated. So the richer you are, the less likely you're going to lie about your income. Now, the true income delinquency negatively correlated. So if you have high true income, you're less likely to be delinquent. Next, your income, income exaggeration delinquency positive. So the more likely you lie, that is a proxy for your personality dishonesty and more you're likely to do it. Okay? So we believe these relations make complete sense. But if you don't control for the lying, then you get quite the opposite result. Okay? Now the next one is the third layer. Okay? So the fact that the bank will sell 90% of the mortgage to the market, will this lower its incentive to monitor carefully about whom to lend to? Okay? And we find a contradiction. Okay? So if you look at before loan origination, if the probability is high that this loan will be sold, the bank cares less about loan. So in expectation, the prospect of loan sale, loan performance are positively correlated. Okay? So the loan more likely to be sold or more likely to be delinquent. But once the loans are sold, we found the relationship flipped. So the bank actually had to be stuck with the worst loans. Okay? Now how do we reconcile this relation? Okay, so first I have to introduce two cutoffs. Okay, this is credit score. There are two magic numbers. You will know if you specialize in real estate finance. 620 separates a poor score with an okay score, and 660 separates a fine score with a good score. Okay, so this is the probability of loan sale. Once you cross 620, cross 660, your probability of loan sale jump immediately. Okay, now what would you expect? Okay. Now, in general, you will think, so this is the delinquency probability, this is credit score. Okay? If the bank would monitor the loan equally, you will think that would just decrease smoothly. So the higher the credit score, the lower the delinquency rate. But we find there's a jump here exactly at 620. Meaning the 619, the credit score with 619 loan have a much lower delinquency probability with a loan at 620. Why this relation is flipped or is perverse? Precisely this loan has much higher probability of being sold than this loan. So you jump up, although the overall relation is smooth down. Okay? But we don't quite find a jump at 660. But 620 is really the key. Okay? So now you understand why the banks are villains, because they try to push the worst loans to the secondary market. But I also want to claim, in the end, they turn out to be victims, because these are the delinquency rate of sold loans. These are delinquency rate of the retained loans. This is 90%, this is 10%. See, it is the sold loans that have lower delinquency rate. How do we explain this? 3 explanations. Okay? One is inventory risk. If the bank originated loans and the loans went bad in 6 months, the investors usually have a put option to put it back. Okay? So that would explain about half of the difference. Okay? We don't find the music chair effect is there. It's not a phenomenon about a crisis. We found the same relation in the good years 04, 05. Now, finally, the remaining difference could be explained by the post-lending information. So investors are not dumb. Okay, so they know the bank tries to take advantage of them. So they would avoid buying loans in neighborhoods where the housing price appreciates slow or depreciated, and pick up loans in the neighborhood when the housing price appreciates fast. So those loans are unlikely to be delinquent. Okay? So, and this would explain all the results. So what are our conclusion? Okay? So we kind of refute banks' defense against predatory lending charges. Okay? They would say, well, how can institutions that suffer the biggest loss be predators? And we just show, yes, you can, because you try to take advantage of other people, but the market is not dumb. In the end, you suffer from the biggest losses. Okay? Thank you.